Good evening, friends. Welcome to the special webinar on your investment roadmap for 2013. I request you to please let me know if the audio is clear to you. You can let us know that through the chat window on your left hand side. Okay, thank you, friends, for letting us know about the audio quality. Uh, so the agenda for the day would be before we get to the investment scenario for the 2013, we would go through what is happening across the world in brief. We'll discuss about US, Europe, China, and India, and then we'll take specific sectors, each sectors. Broadly, what we are covering is banking, IT, FMCG, power sector, cement, metals and energy sector, and one or two of sectors if I may have missed it. So once we have covered our sector outlook, we'll then come to an alternative investments in real estate and gold. I hope you enjoy this presentation. Uh, I am Chaitanya Kekre, an equity research analyst with Moneyworks4me. Along with me is Shaurya Priya, who is our head equity research analyst.
Yeah. Hello, everyone. Yeah. So we'll start this presentation by taking you through various uh, companies' ideas and sectors and how we believe that 2013 will pan out. So this presentation will take you through various things that were encountered in 2012, which was the last year which went by, where we stand in 2013, and based on how we stand here today, and based on where we stand today, how do we expect 2013 to pan out? So the first part in this is where we stand today. So Chaitanya will be taking you through that part. So I'll hand over to him.
Uh, Thank you, Shaurya. We'll first check about what is happening in US first, as it is the most dominant economy in the world. So what we have seen in 2012 was that US had continued with its Goldilocks policy. That is what we mean by that is it has continued to keep on printing money in pursuit of and trying to stabilize the US economy. Uh, it started with QE1 uh, year after the financial crisis has started, but in 2011 it had started with QE2, and in 2012 we had Operation Twist and QE3. Now, am I audible? Please let me know. Uh, okay, thank you. Thank you, friends. Now, what has happened is that in pursuit of this Goldilocks policy, we are seeing that in most of the financial assets market, Fed is becoming the biggest buyer. If you look into money market of US, if you look into government securities market, mortgage market, Fed has become the largest buyer in this. This has resulted in a twin problem. While Fed balance sheet on one side is bloating as time is going ahead, we are also seeing that uh, long-term investors, institutional investors like pension funds and insurance companies, they are not finding sufficient avenues to put the money that they have into any investment asset class, and because of that it is forcing them to invest in a similar asset class of different countries. So you are seeing a lot of money flowing out of US to asset classes of different countries. Specifically because of this reason, we were one of the biggest beneficiaries of it. uh, Now, if you to criticize Fed's policy, we are in a very uncharted territory of monetary policy. These kind of experiments that we have now undertaking has never been tried by any large central bank. The best best example that comes very close to it is what has been tried by Japanese central bank over last 2 decades. And if that is taken as a base case, the performance of this strategy does not seems to be working well uh, for Japan. And if that is the outlook, US becoming economy like Japan would not suit global economy along over next decade or so. So that is one big risk that Ben is running by continuing to expand his balance sheet. On 27 January, I was informed that the Fed balance sheet, which was about $900 billion at the start of the financial crisis, now it has bloated to about $3 trillion. So within span of just 4 years, it has moved from $900 billion to $3 trillion. To put it in perspective, at $900 billion of Fed balance sheet, the US GDP was about $14 trillion. Now with a balance sheet size of 3.13 trillion dollars, the GDP of US is just about 16.5 trillion dollars. So the risk return scenario does not seems to be working for Ben for the limited GDP growth that we had seen over last year, and which also seems to have fizzled out by the end of the quarter 4. It seems that the returns have not come as per expectations. If somewhere one wanted to read Fed minutes in December, there were growing concerns within the Fed itself about the feasibility of this policy. On the positive note, what we are seeing also is that manufacturing is now seeming to return back to US. The best case been the most celebrated case been of Apple saying that it will start manufacturing of some products within US. It already manufactures its processors inside US. So, but while this has been the most celebrated case, there are also other cases wherein we are seeing manufacturing is again coming back to US. Uh, from shoes to gas turbines, many manufacturing plants are seeing fresh order inflows. Second, what we are seeing is that the shale gas revolution that has taken over in US, we believe that once regulatory hurdles towards export of shale is removed, this will add significant long-term benefits to the US economy by first making it independent of dependence of importing energy, which today it does from Gulf. And second, it will allow it to earn a huge amount in export revenues, which should substantially decrease the trade imbalance that it has today with other countries, especially China. Now moving to Europe, Europe is a much more in a dire situation. uh, uh, what I like to call Europe situation is a Draghi Buffett, because uh, what Mr. Draghi, the governor of European Central Bank, has effectively done is that any country in Europe which is facing any type of financial problem can request unlimited amount of support from uh, European Central Bank. The last time such a situation was, there was an post First World War, and a similar situation in Germany had led to a large hyperinflationary scenarios. While we do not expect such scenarios to come in, but we are seeing that incrementally the returns are not coming in over there also. To give you statistics, uh, Spain today currently is running about unemployment level of about 26 percentage, meaning 26 percentage of its population is not having any jobs. In 1930s, when we saw similar level of unemployment was during the Great Depression, that wherein the unemployment level had hit about 28 to 30 percentage. We believe that if such a level of unemployment is hit in any of the PIGS countries, that is Portugal, Italy, Greece, and Spain, we believe that would be first triggered for disengagement of that particular country from European Central Bank. So while yes, financially the problem is solved, financial markets are a bit satisfied now because of the Draghi effect. The bond yields of Greece has come down substantially from 35 percentage to about 10 percentage. For Spain, from 7, it has come down from 7.5 percentage to about 5 percentage. So yes, financially it looks that the things are now becoming stable, but we believe that the problem is now moving to economy and social, wherein it is not yet recognized by policymakers. uh, See, what is happening is that because of the financial problem that had beset in 2011 and 2012 in Europe, the unemployment levels have hit very high levels. Now, because of that, we are seeing social tensions happening in Europe. We are also saying that economically speaking, along with the austerity effect, we are seeing a very low level of disposable income levels among European population, and this is having a very disastrous effect in the consumption pattern of Europe. And to solve this will take large efforts from the policymaker, large sustained efforts on a long term basis to by policymakers, not just within these countries but also countries like France and Germany, to support these countries to get out of it. Let's move to China. In 2012 end, we saw China's new leadership taking over from the old leadership. Now there are some concerns because of the way that leadership has moved. The first concern is, will the China continue with its capitalistic one party policy that it had continued before? On the democratic side, there is some optimism that China may start experimenting with bringing it at least internal democracy. That is, while some party members at lower levels may be selected directly by the people, so some level of democratic freedom may come into China over next 4 to 5 years. But on the economic level, there are big questions raised, not just within China but also by institutions like IMF, whether China can continue with its old growth model. It is a very big misconception that most people have, is that the Chinese growth model is an export driven growth model. Rather, Chinese growth model is much more investment driven model. China invests about 50 percentage of its GDP each year into new investments. Now, uh, while in the early stage of growth, this would have been something of a number that was propelling China towards new development of new assets, and that was helping China in growing, in developing its exports. But now what is happening is that these are giving incrementally low returns. Now, if we are to look into the next slide, let the slide come. I've put two pictures of the slide. Uh, the one is a screenshot on the right hand on your left hand side corner. Top is a screenshot of a city that is in Ordors. It is in Inner Mongolia, that is northern China. Now this is a complete city. It would be somewhat as big as Rajkot in Ahmedabad, or is Rajkot in Gujarat, or probably in two to three times of Nasik in Maharashtra. Now this is a city that is completely empty. A new city has been built and nobody lives over there. We are seeing some similar kind of performances, some similar kind of assets across China. China is building assets wherein there is limited usage of this asset. On the right hand side, there is a beautiful museum that you can see, and there is nobody ever visits that museum. There is no artifact kept in the museum. The museum is just designed for the sake, just built for the sake of building it. There is nothing within it. In late 1980s, something similar was happening in Japan. When Japan was slowing down, the Japanese government started uh, undertaking huge projects, and these were called economic by economists as bridges to nowhere, because bridges were been built but they were not built with the aim of giving any economic return. Now we are seeing something similar in China. We call in China, economists call them as ghost cities. Cities are coming up but there is nobody who is living there. But this is all creating what is, if I go back to my first slide, we are seeing a deep structural problem coming in Chinese banks have huge amount of assets that are used to finance these particular projects. We do not believe that these kind of projects, if continued in similar fashion, will give economic returns. So China has a huge banking problem that it needs to take care of immediately. Moving to India, as you all may be aware, the governor Dr. Subbarao, he had cut interest rates, that is repo rate, by 25 basis point and CRR by another 25 basis point. We believe that Subbarao is again taking a risk. The risk is on the side that government will continue with reform measures. Last time when this had happened, Governor Subbarao had cut interest rates by 50 basis point in August 2012. That was under the uh, implicit enough promise by then finance minister Mr. Pranab Mukherjee that the government will continue with the reform business, but it had not happened so. But given that some reform actions had been made by government during December and early January, especially the reforms in the fuel subsidy, we see that governor has some basis of saying being optimistic on that side. But within his monetary policy, he had clearly mentioned that he has very little room for providing further stimulus, monetary stimulus. So we believe that would play up in the next year unless government comes with a very reformistic budget. Now, speaking of the budget, this time would be a bit challenging from Mr. Chidambaram to come up with a very reformistic budget, while this is what he has been promising across the globe in his visit to with foreign institutional investors. The reason this we believe that this is a bit hard is because people must remember that this would be his last budget as finance minister in UPA 2. uh, being the last budget before election, there is a very high incentive on the part of Congress party to force a populist budget. And now Chidambaram will have to play a bit of a balancing act wherein he would have to satisfy both governor as well as rating agency so that India does not get downgraded, as well as RBI does not reverses its stand on interest rates. And on the other side, he also would have to see that can he satisfy the requirements of certain leaders within Congress to come up with a much more pro poor, pro reformist, pro populist budget in February. This would get clear only in February. What our thinking as a house goes is that he would come with a bit of both. Certain disinvestments which were planned in 2012 will happen mostly in 2013 and 14. The big ones that he has within his pockets, he just needs to get it confirmed along with his allies, is Hindustan Zinc Limited and Balco, which together should fetch him about 30,000 crores. I believe he can mop up another 10-15,000 crores from disinvestment in sale in IOCL, uh, IPO of Hindustan Aeronautics Limited, and such other companies. That together gives him a firepower of 50,000 crores. We believe he would also be planning for a lower level of fuel subsidy, as oil companies, as you know, have now been allowed to increase the prices of diesel each month by 45 to 50 paise each month. So this should allow oil companies to come up with a lower subsidy bill, and I believe that saving of another 10 to 15,000 crores will also, this totals 15,000 crores from savings on oil subsidy and 50,000 crores savings from earnings from disinvestment he would probably use in funneling some pet schemes of an UPA, that is Narega, and to some extent Aadhaar also. Now let us get to banking. About banking, our research head Shaurya would be picking it up.
Yeah. Thanks, Chaitanya, for the insightful presentation on domestic and global economy. Now I'd be taking you through some sectors. Chaitanya and I would be taking you through some sectors and what are our expectations from those sectors. We'll also talk about a few stocks from each of the sectors, which can be either good or be bad. So we'll start with banking sector. As all of you can see that banking, the title is rainbow. So when does a rainbow generally appear on the horizon? It appears after some dark gloomy clouds have passed out some rain. So banking stands at the same situation. Uh, Although the banking sector index did well and it outperformed the Nifty in the past year, but the performance was solely based on outperformance by private sector banks. Most of the public sector banks languished because of concerns over non-performing assets. However, we expect that in the coming year, the banking stocks are likely to perform better than they did in the last year. and most of this will be due to improving balance sheet and profit and loss statements of public sector banks. Private sector banks, as you're aware, have already performed well. So before moving on to those aspects, I'll just ask Chaitanya to give you a summary of how has the last year panned out for banks.
So last year, what we saw was that while there was large concerns in the initial part of the year that the balance sheet of PSU's bank would not be were under huge stress given the fact that their interest rates were high and we were seeing large number of loans getting restructured. But we also saw that by the end of the year, PSU banks were giving good growth as far as share prices were concerned. Uh, we also saw that by the end of the year, some companies like SBI and PNB, they are giving much better returns over Sensex than what had been given previously by them. Over the year, private banks have performed decently as far as share prices have concerned.
Yeah. So this has been about the past year and how this performance panned out. This performance panned out largely on the basis of public sector banks not performing well. Otherwise, the outperformance would have been even robust. So, as you can see in the slide itself, a rainbow is something which we expect from public sector banks because public sector banks are likely to recover in terms of their asset qualities because of them taking lesser risk on their balance sheet and at the same time going aggressively after reducing their NPAs and recovering from accounts which have already been declared NPAs. The current valuations of most of the public sector banks largely discount most of the negatives, and any improvement in asset quality here on will lead to strong recovery. I guess some of you witnessed a strong recovery in Punjab National Bank yesterday when it rose by 10%, which was largely on account of its NPAs coming in lesser than what the street had expected. So, going ahead into the year, we expect more and more PSU banks to come out of the deep pit they were in, and public sector banks are likely to perform better going ahead. Another comfort on public sector banks is on basis of valuations. Most of the public sector banks are quoting below their book value, which makes them compelling buys. Even if there is some more asset stress going ahead into the future, they will perform well going ahead in the long run. Private banks are also likely to perform well going ahead into the year, but largely stock price outperformance will only come when most of these private sector banks outperform the expectations. Already there are expectations that most of the private sector banks will deliver strong set of numbers in the coming year. So, for any price outperformance to take place, they need to outperform the street expectations. And on the other side, any disappointment on the expectations which have already been built into, they are likely to disappoint. So, on a risk reward terms of trade, I'll favor public sector banks more than private sector banks. This is also likely to be aided by economy going ahead into the future. From second to third quarter of coming financial year, that is sometime in, let's say, in June to September sort of thing, we expect that economy will have come out of the bottom that it is in currently, and that will also be a positive for these banks. So I'll just present to you a few of the banks which you should look to. First is obviously Punjab National Bank that I talked about, and it was also one of the stocks mentioned in the presentation. Punjab National Bank is likely to be a beneficiary of improving asset quality. Uh, because the bank has really taken a very strong and the management view is that they are likely to reduce their NPS going ahead further. Because even if you look at the core operating performance, the bank has performed well. It is only on the account of the hit that it has to be that it has had to take due to NPS that the bank underperformed on the bottom line. However, going ahead, this is likely to improve, and the bank is likely to deliver strong performance. Even the valuations give us some comfort on Punjab National Bank. Another bank which is in the same place as Punjab National Bank is Indian Bank, which was another of the stocks mentioned in stocks to watch in 2013. The bank has very compelling valuations, and it is also likely to benefit from capital infusion by government. The bank has a very strong base in the western and southern part of the country, which are likely to perform well because are the industrialized and more economically advanced areas of the country, and those are the areas which suffered most in the current down cycle. So, in any up cycle, those are the areas which are likely to benefit. Another stock which I'd like to tell is ICICI Bank. The bank is likely to deliver good business performance going ahead. However, the valuation comfort on the stock is not there. The stock is trading at currently historically high valuations. If you discount the period from 2006 to 2008, the bank is at a high level of valuations, and any negative surprise would lead to a fall in stock prices. Another stock over which we are circumspect is HDFC Bank. And this is because the bank is strongly leveraged to retail segment. And in coming 6 months, the consumer confidence is not high. Some of you might have already read in today's newspaper that the consumer confidence index is at multi-year lows and it has been dropping further. So HDFC being largely leveraged to retail segment, there might be dark clouds over the stock. And in any case, the valuations are very rich for the company. So any negative impact on the stock will likely to lead to a very negative returns in stock price. Next sector that we'll cover is okay. Let Chaitanya.
Sure. Yeah, one of the participants had a question whether it's this right time to enter into Indian bank or not, given that 1 month had already over and we had already spoken about this stock in our last month.
Yeah. Uh, it basically depends on your investment horizon. A right time to enter Indian bank would be at prices close to, let's say, 180. However, the current stock prices, I guess, I believe, closer to 200. However, if you are an investor whose investment horizon is 3 years or more, you would not like to wait for those prices of 180 or to be reached. You could directly dip in and invest some part of your allocated capital to Indian Bank right now rather than waiting for the prices to drop further. Yeah, Chaitanya.
Yeah, thank you, Shaurya. Just a word of advice to our friends who are listening to us. I understand you have some stock queries. Please take those queries as and when we are speaking about that particular sector. This allows us to base it within the talk that we are giving to you. So, if you give it before, then like some of you have asked about Sesagoa and ITC. So please ask please let me know about Sesagoa during the metals and ITC during the FMCG so that I can give you a better answer out of it. Okay. I hope please you can help me on this part. Thank you. Uh,
Yeah,
uh,
I
there is one query whether he should get away from HDFC Bank.
Yeah, Naveen from Hyderabad asked in that do you mean to stay away from HDFC Bank? Well, Naveen, it depends on your investment time horizon. If you are a long-term investor whose investment time horizon is, let's say, more than 3 years, I'd advise you to stay invested in the stock. However, for people who are not owning the stock and who want to enter or buy HDFC Bank, I believe that in the course of this year, you will get better opportunities and better prices at which you can enter HDFC Bank. Now we'll move forward to the next sector, which is capital goods sector. Uh, Let the slide come on the screen, then we'll move forward. Yeah. So now we have the slide on the screen. Capital goods, as you can see, we expect some bumpy ride ahead, which means which means that basically there will be opportunities galore in capital goods. However, these opportunities are not for the faint-hearted. People who'd like to be risk averse and take lesser amount of risk should do well to be cautious. I won't say avoid, but be cautious on capital goods sector. However, for people who are looking at higher absolute returns in coming, let's say, 3 to 5 years, this will be a good time to buy into some of the best capital goods stocks like BHEL, because uh, uh, the valuations are very compelling for this sector. Before moving on to stock specific things, I'd like Chaitanya to take you through how the last year panned out for capital goods.
Now, what we saw in the last year, Shaurya, was that capital goods sector, while continuing to show very good valuation levels, had not given us that good return. Sensex has, we are seeing, as you can see on the slide also, is that Sensex had outperformed capital goods sector. Most of the people may have made better money by staying away from capital goods sector. And paradoxically, 2012 was also a very good year for long-term investor to invest into certain companies in capital goods sector, especially companies like BHEL. Uh, these are companies that we believe, if we believe in India story, would give investors very good returns over next few years. So, but there were other stories like Crompton Greaves. At times, and people started expecting that the next quarter would be a much better quarter, but things have already always been in a bad for companies like Crompton Greaves. But same way as I speak about BHEL, Crompton Greaves makes a good story over long term, but might not be a very good story in the short term. You may see lots of times when you may have bought stock at, let's say, 130 prices, and then it falls down to about 100 price again. These kind of bumps will come in companies in capital goods sector. One big reason for capital goods sector to be of this type is, if you see at IIP number, we are seeing that the industrial production number index has consistently been falling. Until August 2012, it was in the negative zone, meaning we are seeing lower levels of an industry production than what we were expecting. Now, if this were to continue, this will not be run very good for capital goods sector. And given the fact that even the gross capital formation was not very good over last year compared to what we had typically enjoyed, this is not turning out well for capital goods sector. But I believe government is actively looking at and making the investment scenario look good. Once certain reforms are in place, capital goods sector should outperform most other sectors as such.
Yeah. So even if you look, can Chaitanya, can you take me through to the next slide? Even if you look at the gross fixed capital formation, that has dropped drastically since 2007 or beginning of 2008. It recovered somewhat in 2010, but again it is at very low levels, though still being positive at present. However, we expect that the government might try to increase spending on infrastructure, which it was not able to do in past few years, because that is a big bottleneck. That is point one, and point two is that it intends to kickstart increasing avenues for employment, because as of all of you are aware that infrastructure is one of the largest employment generators in any country, and even at the lower segments of the society, the benefits of investing in infrastructure are high. uh, so capital goods as a whole would benefit. You also see that there is a lot of power shortage in India. Even in the big cities of India, power cuts do take place on a regular basis. So power is another sector where capital goods had a large order flow coming in from in past few years. However, if you believe that India has to really realize its potential, it is absolutely necessary for the government to improve the power situation in the country. And for improving power situation, the government has already taken a few steps like improving coal linkages and policies for importing coal and other fossil fuels, which are generally raw material for power sector. And going forward, if more power plants are set up, then order flow to this sector would improve drastically. That is one sector where capital goods industry as a whole will look forward to for order flow. Another sector can be oil and gas companies. As more and more refining and even exploration capacity in India, exploration and production capacity in India is coming up, capital goods sector is likely to provide most of the engineering goods for those companies. Uh, I'll now request Chaitanya to take you some of the companies that we would like to talk to you about.
Thank you, Shaurya. I speak with, since you were speaking about oil and gas companies coming up with projects, I'll speak with, starting with EIL first. Engineers India Limited is a very compelling story. Given its market price of 220 rupees, we see that it has very limited downside. Due to market irrationality, it is possible that the stock may go down, but if it goes down more, I would tend to buy more. The reason being very simple: it has very large amount of cash in its books. Second is, what we typically see is that before the start of any 5-year plan, most oil and gas most government owned oil companies do not come up with their planned investments. Most of these investments are phased in the second half of the 5-year plan. So if the new 5-year plan is to be from 2013 to 17, then it will happen mostly in between 2015 to 17. So given the fact that much of this orders inflow will start happening in 2015-17, we believe that EIL, buying into EIL in this low prices will be very beneficial. On the positive note on EIL for the next few years, EIL has already got a consulting order from IOCL for the new green field refinery that is coming up in western state of Gujarat. So that is already there. The next is Bharat Electronics Limited. Bharat Electronics Limited is unlike any other capital goods company. The pure and simple reason being, the biggest customer for Bharat Electronics Limited is the defense companies. So given the fact that we are hearing some noises that we may see some budget cuts for the defense, we believe that the weakness in Bharat Electronics over next few months can be used to buy into Bharat Electronics. Similar to like EIL, Bharat Electronics has very high amount of cash in its book. Second, among the all government companies and private companies, the percentage of revenues that Bharat Electronics invests in R&D is unmatched. About 10 percentage of its money is invested into R&D. Second, whenever you see any missiles, any uh, tanks, or any aeroplane bought, please remember much of the electronic component may be developed at Bharat Electronics. This That is why we are not. It is very encouraging to see that even in these periods, Bharat Electronics has an order book of 25,000 crores, which should work out about to 4 to 5 years as such. The next company is Cummins India Limited. The reason we love this company is that consistently Cummins India has shown very high return on invested capital. We would be making some changes to our 10-year XA. One of those changes would be how return on invested capital compares with the cost of capital. And in this, we see Cummins India Limited as one of the best companies, because there has been consistency and the high return on invested capital has been generated throughout the period. The second part is, we also see that the company has also consistently generated very high free cash flows. These are two markers that we typically see before we become excited about any company. So given the right valuations, Cummins India would make highly compelling sense. Crompton Greaves is a much more contrarian story. The reason being, we believe that all the negatives that are within the Crompton Greaves are already priced in. Any turnaround in the economic activity, even in Europe, either in Europe or India, can significantly contribute to the upside for Crompton Greaves as far as the business and the stock is concerned. Surprisingly, to our clients, we are not that bullish on ABB Limited. The reason is that the multinational company has shown very poor financial performance. We believe the valuations continue to remain high. We do not foresee that given the unless and until there is a significant upside on the financial performance, there can be any upside to the stock as such, uh, given that the valuations are already stretched for the particular company. Let's now move to the next sector, that is IT.
Yeah, before Chaitanya, before we move to IT, we receive a lot of queries on BHEL, Bharat Heavy Electricals Limited, and I think that it is a pertinent time to address some of those queries. See, BHEL is one of the best capital goods companies, not only in India but probably in the world. Uh, the equipments that it makes, uh, it operates in a segment where it is very difficult to set up capacities on the scale that BHEL already has. For example, if I were to give you an example, BHEL does not manufacture fluorescent lights or bulbs like Havells or Crompton Greaves. It manufactures critical engineering equipments for power, oil and gas sectors, etc. It is very hard to have competency in manufacturing those equipments, and BHEL is one of the best manufacturers of such equipments. Chinese equipments which come from Dongfang, etc., don't even match to the criteria of equipment that BHEL has. Currently, because of the slowdown in the sector as a whole, the stock is beaten down. However, BHEL is a company which is a very apt investment for a value investor, an investor who is willing to stay invested in the stock for long run. Because as the situation improves, BHEL will be one of the biggest outperformers in the Nifty stocks. So people who are in for investing for, let's say, 6 months, 1 year, or maybe even 2 years would do well to not be very bullish on BHEL, but people who are in it for long run would certainly like to invest in BHEL. Uh, Yeah, some people are also asking about Maharashtra seamless, but we'll cover that when we move to metal section because that is more aligned to metal sector rather than capital goods. So please be patient. We'll now move on to IT sector, and Chaitanya will take you through how IT sector things panned out for IT sector in 2012.
To address some query why valuation is the driving concern while we recommend any stock is, see, the basic of any valuation is based on the fact that how is the future of the business is going to pan out, not of the stock is going to pan out. We have seen at times that while valuation might not make any sense and the stock still continues to rise. The problem with investing in such type of companies is that you never know when the bottom will fall out from the sky for these particular types of companies. Now, to give you a perspective, a very good fund manager who was employed with George Soros, he kept on investing during the internet bubble time. And when he was asked why did you continue to invest knowing that the valuations were not right, he said we were into use in a cricketing term instead of the baseball term. He said effectively, he said that we thought we were in the 10th over rather, but we realized later that we were in the 50th over already. So what we mean to say is that when valuations are not right, we do not know when things can go very horribly wrong for the company. On the other side, it works out similarly. When valuations are right, but market is not realizing it, we again might not know when market will really realize it, and things may start looking very high for it. We had similar complaints on company like Infosys about 3-4 months back that the valuations were very high, but the company stock was not performing it. And we saw that once there was a slight upturn in the Infosys performance. In a single day, the stock had moved up 17%. A company like Infosys moving up 17% is a big event in the stock market. So valuation is what drives us. Yes, there are other judgment calls that also we take, but you need to understand that there is some limitation beyond which we cannot take such kind of judgment calls. So valuations will always drive our recommendations, irrespective of how market is seeing it. We may be wrong because we may be missing out some information about the company, but typically stock investment made on the basis of valuation should give you higher returns on an average than otherwise. Coming to IT industry, uh, uh, the question that is of concern within the IT industry is, can it withstand the ripples that are happening in the Europe and US? The typical business model of IT industry that has developed in India, unlike other countries, is outsourcing. We get outsourced business from US and Europe. So it is the exports of from India to these countries that drive sales and revenues of these companies. Now, given the fact that both Europe and US are seeing weaknesses, now there is a paradox over here. Weakness may lead to cost cutting in European and American companies, in the form of cost, because of the pressure on cost cutting. It is possible that they may look to automate many things, and so you may see more outsourcing activities happening. But on the other hand, and a weakness may also result in that the fact that some of these projects which they may think of as non-critical, they may either postpone it or cancel it. Plus, what may also happen is that they may start negotiating harder with the vendors. That is, they may start negotiating harder with Infosys, TCS, and Wipro, and because of this, you may see that the margins might not be that high. One of the big reasons why Infosys was a laggard as far as IT pack was, because we had generally seen from the comments from the management was that it was not willing to give away margins in the short terms in order to jeopardize its pricing power over long term. This being the strategy, we were not seeing large growth happening in Infosys revenue numbers. But once in the end of December, when things started looking up and Infosys started giving away some of its margin, we saw good revenue expansion and good profit growth from Infosys. Not surprisingly, Infosys has also come up with a good revenue guidance for the next full year. Uh, Now I'll hand over to Shaurya. He'll tell you about what the future may pan out for an IT industry as such.
Yeah. So basically, the future for IT companies now lies more towards managing their profits, because the kind of supernormal operating margins or net profit margins that IT industry used to enjoy for last 5 to 7 years, it will be difficult to sustain that sort of margins going ahead. So they'll have to take a call on the sort of margins that they would like going ahead into the future. Even Infosys, one of the most conservative companies on margin, is now willing to shed some of its margins for sales growth, which is a good sign. And that is why companies like, let's say, Cognizant have been able to catch up with Indian IT companies. Cognizant, as all of you know, is US headquartered company. Uh, Now, there will be a shift towards non-linear initiatives contributing to revenue growth going ahead, which will lead to lower costs and performance. Non-linear initiatives means newer initiatives or initiatives apart from sectors like, let's say, BFSI. So the sectors which will be the crux of IT companies for growth in coming future may be sectors like, let's say, pharma or hospital management or defense sector, where HCL has already built in a big order or list of clientele for itself. Then there are strong growth opportunities expected in tier 2 and 3 cities in India. Many of you might well be aware that IT companies are now expanding beyond the bigger cities and moving into tier 2 and tier 3 cities like, let's say, Jaipur, Bhubaneswar, Indore, Pune, etc. This leads to lower cost on their part, because both the real estate and the labor cost decrease when you move from a bigger city to a smaller city. So this might help them in some extent in cost rationalization. And another thing to watch out for is shift towards disruptive technologies, including cloud computing and social media, because this again leads to efficient cost management and even efficient scalability going ahead into the future. So a higher amount of technology adoption and outsourcing by Indian corporations and government is expected in 2013. Mid-cap IT providers like, let's say, Hexaware, iGate, Persistent are expected to be active on acquisition front, because they have a decent enough cash pool and they would like to expand into areas where areas or even geographies where they are not present and like to bridge in some of those gaps going ahead. Global IT industry as a whole is likely to have better growth prospects in 2013 on account of removal of uncertainties regarding EU disintegration or even US election being over. And recently there was the move by US government to grant higher visas for higher educational studies in US, which in turn might lead to better immigration or even better visa norms for people going ahead, which is the expectation of the industry. Niche sectors like healthcare and insurance, as I talked about earlier, are likely to witness innovation and growth on both fronts. Some of the companies that we'd like to discuss are first, Zensar Technologies. Because the company is diversified, it has shown growth through investments in disruptive technologies. So Zensar Technologies is well placed going ahead into the future. Another company is eClerx, which is a very niche player, a sort of KPO model. KPO stands for Knowledge Process Outsourcing or Offshoring. So eClerx basically operates in KPO segment, and as you know, in the Western world, to rationalize or lower the cost, more and more of the work which is algorithmic or routine work is being outsourced to countries like India, where it can be done at a cheaper cost, and companies can maintain their either maintain their margins or at least be profitable. So eClerx is another company which is strongly placed. Now I guess we'll move ahead to the next sector, which is metals and energy.
Just more clarity on eClerx. eClerx had taken over a certain business in US. Now, because of that business, what we had seen is that while eClerx had added certain employees on the marketing and sales front, but they have not been able because they have not got time as such for because they have just been recruited. But that have added to the cost side of the eClerx, and because of which the margins have decreased in the short term. We'll believe that be as it is trying to enter into one more new sector, it may take some time for it to recoup on the investment that it is making by hiring some high marketing and sales professions. But once these orders start kicking in within, let's say, next 6 to 9 months, we believe that that weakness within the profit and loss statement and margins of an e-clerks would be substantially be removed. So this weakness should be actually be used in the e-clerks over next 6 to 9 months to be bought into the e-clerks, and any fall in the stock because of an weaker margins, I request you to check with us first, but most of the time you can enter into it. Yeah, Nias from Dubai, I think at this price around 630, it is a decent price to enter into it. But yes, please be careful that given that the quarterly results might not be very spectacular, it can still go down about 10 to 15 percent down. But any such weakness should be used to buy into it rather than staying away from it. You can phase your buying over next 6 to 7 months as such. Now, there were few questions. One was, is there any mobile software company? On Mobile is the one company that comes very close as mobile software company, but mobile software is going through a large uh, disruption of its own. The apps are changing. The app-based business model is redefining the business model of mobile software as such. Uh, on Mobile does not seems to be that well placed in it, but otherwise most of the app companies that are based out of India remain to be unlisted as of now. So the share market might not be the way to invest into these kind of companies. And sure, some had questions about Polaris Software and First Source. If you can give us some outlook about them in just a brief.
Yeah. Uh, as regards Polaris software, I guess there is an expectations that the company might do well going ahead, because Mr. Jan, who is the CEO of the company, he made some strategic moves which did not work out for Polaris in last 2 to 3 years, and as a result, the stock has languished. I believe there has been a fresh rethink on the strategy that the company is going ahead, and the management is now moving towards that. However, the returns of those restructuring or strategic rethink is still a hazy thing. So at present, I'd like to stay on sidelines rather than enter the stock with vigor.
Thank you, folks. I understand you like query on each and every company, but due to the paucity of time, I cannot cover it. Just to inform you, we regularly have subscriber webinars in which you can get this query, register this query at the earliest, so that I can answer them in much more detail. Or you can always drop your mail to us to customer care, and we will be always be kind to give you a very detailed report on it. uh, the next sector is metals and energy. I know some people who are very interested in Maharashtra seamless. I will be covering that in this part of the presentation. Now, metals and energy. The theme that I am big concerned about is this the end of the super cycle? As you all know, from 2000 to 2012, 2000 to 2008, we had seen a huge increase in prices. Now let's see what things had panned out before I come to my theme. Now metals as such had not given a very good returns. If you would have bought at the right time, you may have seen some returns of 10 to 15% as such only. Most companies in metal sectors have given very lackluster performance. Though yes, there were always selective opportunities if the timing was correct. The key word was if the timing was correct. In short term, I hardly think any good metal company would have given you decent returns. One of the big reasons is that situation in certain metal groups, that is the metal commodity itself, continues to be very bad. Specifically aluminum and copper continues to be so bad that quite a many number of players cannot even cover the cost that is involved in manufacturing of the basic metal itself. Globally, further what we are seeing is that the weakness in Europe, US, and also initially, at least in the first half of the 6 months, the expectation of hard landing in China led to very low investment and consumption activity across the board. This was very negative for the metal sector as such. Let's look into certain graphs of metal prices. That would be a better indicator. Iron ore prices, to speak about for it at the start, were stable for quite a long term, for quite a long time till April 2012. But then they had a slide. The big reason was the China slowing down, expectation of China hard landing. About 50 percentage of iron ore that is produced across the world is consumed in China, and so China hard landing would have been a big impact to iron ore prices. This was a large reason for the iron ore prices to fall down from about 140s to about 100 dollars. But after that, once it was clear that China would not see a hard landing, and the Chinese GDP would continue to record somewhere in between 7 to 8 percentage GDP growth rate as per the target set by the Politburo of China, iron ore prices have started to recover. The biggest problem has been on the aluminum price side. Even at the peak price of 2200, most companies were not even recovering their basic cost, which for companies like Hindalco and Vedanta Aluminium, which is an associate company of Sterlite for now, their basic cost of goods price itself, mine price itself, would be up somewhere in the region of 2100. So even after doing value addition and incurring another cost of extraction, they would not have recovered any money. Now this got much more worse around the period of August and September, June, July, August, the that is quarter 2, as an aluminum prices continue to hit rock bottom. Again, just like iron ore, aluminum is also largely consumed in China and global economy and developed economies like US and Europe. Uh, but as China started stabilizing and US was also returning to some amount of consumption growth, we saw that at least aluminum prices are now heading back to 2200. But for aluminum companies to really make money, they would need some this price to be at least about $2300. Zinc was an interesting story because zinc continues to be very profitable for zinc companies. This is largely due to the fact that slowly we are seeing that over next 3 to 4 years, lots of old zinc mines will close. So while demand has moderated to some extent, supply has is receding at a much more faster extent. So this continues to give support to zinc prices. So companies like Hindustan Zinc should do extremely well, who have very good, whose major source of income is based on the zinc prices. and because of Hindustan Zinc being a big subsidiary of Sterlite, Sterlite should also do well because of that. Copper prices continue to languish in between 7,000 to 500 to 8,500 range. The problem with copper prices is again related to supply. Over last few decades, what we have seen is in major areas where copper has been typically been used, copper has been steadily been replaced by aluminium. And given the fact that we are seeing that a large mine that has been developed by Rio Tinto in Mongolia coming operational within next 2 years, copper prices will continue to be under pressure. So this is a bit of a bad news for both Hindalco and to Sterlite to some extent. Significantly though, copper is not that dominant a business for both of them. uh, Now coming to commodity fuel price index, if I look over long term of last 4 years, what we have seen is that the commodity prices had been on its peak around 2008 April June, once and the crisis had set in, and they had nearly crashed. This was true for nearly all commodity prices. But now when it seems that prices have recovered, but over long term we might not see the peaks quite early as we had seen in the 2008. Now coming to coal prices, folks, you need to pay attention on this side, because the coal prices, natural gas prices would be one theme that will become recurrent in most of the other sectors who are very dependent on it. In the early part of the year, we saw coal prices becoming very hard, and this was the problem that was happening in power sectors. You may remember that many power sector companies who were building new power plants had petitioned to the government to allow for the increase of the electricity prices. This was largely because of the high coal prices. Now, because of many reasons, we are seeing coal prices to start weaken. We believe this is a long term trend. On an inflation adjusted basis, we do not believe coal prices would be significantly higher than what they were in 2010-11. The one of the big reasons being the natural gas prices. The reason of natural gas prices impacting on other prices like coal as well as to some extent crude is because of the shale gas revolution that has happened in US. Now, because of the shale gas revolution that has happened in US, what we have seen is that natural gas prices, which were typically in the range of $5 to $6 per MMBTU, have fallen down to about $2. Now, at this price range of $2, it is not feasible for most new projects of shale gas to get commissioned further. But this low prices is also resulting in certain companies which were using coal as one of the biggest thermal fuel. They are shifting to natural gases. To give you an anecdote, most US based coal power plants now use natural gas to fire their boilers. So this is the big shift that we are seeing. One of the reasons, because of natural gas, we are seeing that even certain big large coal mines itself are not being mined as of now. Good for India, because we continue to import good quality coal from outside of India. This would be good for any energy intensive company. The same thing that is running with coal is also happening with crude. Crude has another factor playing in, that is related to regional tensions happening in Iran. If those play out, crude may again move up towards 150, but unless that happens, crude will trade in a very tight zone in between 90 to 120. It will touch 120 if US economy were to grow at a faster rate, given the fact that we have been printing huge amount of currency in US and Europe. But if weakness were to be seen in the American economy for further period, and if we not liking it, but if another recession coming in setting in US, we may see that the crude prices may fall down to 90 again. Now, is this the end of commodity cycle? That is what was the question that I have posed at the start. If you see the graph, it is we see clearly that the prices of fuel had increased from to very low levels to very high. uh, by March 2000, but after the financial crisis they have corrected. And what is significant is now they are seem to be plateauing level of another fuel prices. The similar trend is seen in metal price also. Or when you see a long term picture, We see a initial rush, then we see a fall, and now we are seeing, if I go back to my previous slide, which is just for the year, we are seeing a bit of plateau of the metal prices. The big reason is that uh, if I see historically, the big nations that have always dominated the world GDP always have been India and China. It is only over last 200 to 250 years that India and Chinese GDP had not kept pace with the global GDP, with the GDP of other developed economies. Because of that, we have seen that over last 50 to 60 years, both these countries have not been making the type of investment, the type of infrastructure growth that was needed. The only country that started making was China in the earliest part of the year, in the early part of the decade, and as Chinese consumption started increasing for this particular for both fuel as well as for metals, we saw the prices of both of these commodities starting to increase a lot. But now that we are seeing a return of ghost cities, return of bridges to nowhere in China, the incremental investment that China can do and which can drive metal prices is very limited. So now for metal prices to really increase, there are two factors that are very clearly needed. One is uh, China has to continue to start investing, but the big thing is India and other emerging economies. I do not mean to say Brazil and Russia, but I specifically mean to say countries like Mexico, countries like Turkey. These need to start picking up with the slack. They also need to start investing into new projects. Significantly, I even count US in it, because if you look into US has not started any big infrastructure project for last quite many years, and much of its infrastructure is now creaking. It needs to refurbish its infrastructure so that it can continue to remain one of the world's largest dominant country. Now, the chart that you can see is what is the Fed's balance sheet. The reason I bring it over here is because this is going to drive most commodity prices, that is metals, fuels, as well as precious metals. Now, if you see at the early stage of 2008, the before the Lehman crisis had hit, the effectively Fed balance sheet was not more than about 1,200 and 1.2 trillion dollars. This had now increased to 3.3 trillion dollars based on the multiple economic easing and policies followed by Fed. And given the rate of 85 billion dollars per month that Fed has committed to do for over next few years, we believe it would not be long that it would touch about 4 trillion dollars. We expect it should happen by November of this year. Uh, Given this, in fact, the last printing, we believe that thanks to Ben, metal prices will continue to have an upward lift, at least as far as the prices are concerned. But if unless demand also picks up, the prices will continue to trade on a very tight territory. Uh, to summarize, what I would like to say is, till Ben and Draghi, you keep printing money, metal prices are not going to fall out of the roof, and they are rather going to continue with their upward journey with a slower momentum. But if China can avoid hard landing and it restructures its economic model, because currently its economic model of focusing mostly on investment to drive its economy is clearly not sustainable. But if it can prop up its local consumption, then we can see a very big story coming up in China that should also give a very good demand support to the metal companies. On the other side, locally, if I see, there are three things that I keep looking forward to. One is uh, metal mining companies have been engulfed over last 2 years in court cases, specifically with regard to environment clearances. I believe that in 2013 may be a year when we can get a very good clarity on this, especially with iron ore companies both in Karnataka and Goa. Once this environmental clearances are given, once there is some clarity on this, it would be better, much more easy to take a call on these companies. The other two things is, India is a very mineral rich country, but unfortunately we have failed consistently to tap into that minerals. One big reason is we do not have very clear cut policy on how such mineral rich land can be allocated. because of the nature of the policy that is designed, we continue to get s- uh, things like coal scam. It is the nature of the policy that has been designed, because of which we see that there is much more there is very less transparency in the way this uh, resource belts, resource land, rich lands are allocated to the companies. Now, companies that I like are companies that would have very good focus on project execution, who can get their project cleared before the next boom starts. And others are companies who are focusing a lot on maintaining their reserves and consistently adding to them. Companies like Sesagoa, who have consistently tried to add reserves to them. I believe that these companies will continue to drive value for their shareholders, even if there are some minor glitches in the short term. Mm, so the companies that I like, MOL, the reason I like MOL is it is the only PSU firm that can sell its ore at market prices. All other PSU firms, whether it is NMDC or Coal India, they have to sell their ores at government determined prices, which is a substantially discount to the market determined price. The key factor that should drive MOL is manganese is specifically used in structural steel. So once investment climate to revive globally, manganese prices should be very strong. So that should be very beneficial to MOL. On the other hand, MOL continues to have very strong reserves and very strong cash position that gives a good support to MOL's valuations on the downside. Second company on similar lines, NMDC, but one big reason that differentiates NMDC from its other peers is that NMDC is much more aggressive as far as PSU firms are concerned in its international expansion. It already has bought into a mine in Australia, that is Legacy Iron Ore, in the western region of Australia. Now, this mine itself is as huge as the current reserves of NMDC. So I believe that given the reserve size of that particular mine and it been in the advanced stage of starting of the mining and extraction side of it, which should then start within the next 2 to 3 years. NMDC is a very compelling buy in longer term. On similar lines, I like SAIL, but I do not like Tata Steel. The reasons are similar. SAIL has a very strong balance sheet, while Tata Steel has a the balance sheet is very loaded with high debt. The debt that Tata Steel had incurred is while acquisition of Chorus. The fact that weakness in Europe is leading to very low capacity utilization, as Chorus is a drag on Tata Steel. On the other hand, SAIL does not has very high levels of debt. It also has very high level of cash position to support if a debt has is getting matured. Secondly, its project should get finished by 2015 and 16, and because of these new projects getting cleared, would be margin expansion, because these are projects that are all high value added steels. These are much more premium steel, so margins on these products are much more higher than what it is. Now, coming to the Maharashtra Seamless, that has been giving sleepless nights to many people. We continue to believe that Maharashtra Seamless is a value proposition. Yes, over short term, yes, Maharashtra Seamless will continue to have some weakness in the price built in. The reason is because Maharashtra Seamless continues to drives about 66% of its revenues from export. Now, the biggest chunk that contributes to exports are pipes that go into oil and gas sector. Now, as I showed you in the previous slide, that the natural gas prices have come down at a very low level, such that it is not feasible for most shale gas companies to continue with their capital expenditure program. Because of that, we are seeing that there is weakness in order levels at in the piping business as such. Um, there's someone from Ahmedabad who is saying voice. Okay. Now, what we believe is that given the surplus nature of energy within US, there is a reason why American companies cannot export their surplus energy either in form of natural gas or either in form of oil that they produce. They cannot export it because of the policy uh, inherently and explicitly and blocks them from exporting these energy commodities, we believe that one of the big policy decisions that would be taken by Obama over next Obama administration over next 1 year is that he would allow an export of shale gas to certain extent. This should give a huge upside to shale gas prices. Shale gas prices should recover back to their $4 to $5 level. This should also allow shale gas projects to which were have been kept on hold to again come online. Now there are four big companies in piping business: Maharashtra Seamless, Jindal Saw, Welspun, and PSL. Out of this, we like Maharashtra Seamless because it has no debt. It has no debt. It has 500 crores of cash. It is a 1700 crores company, and yet it has 500 crores of cash. And given its in a low debt position and given its margin position, we believe that Maharashtra Seamless will continue to be a value buy. Uh, One more thing that I would like to bring attention to our friends is its book value or net worth of Maharashtra Seamless comes down to about 2,700 crores. Now, given the fact that a 2,700 crores net worth company is trading at 1,700 crores price, we believe that Maharashtra Seamless is a huge value buy. We have seen this cycle in price to book value basis in Maharashtra Seamless playing out over last 10 years. About in 2001 2002, again its book value was about price to book ratio was about 0.85. It is again 0.85, and during the good times it expands to about 2 to 3 times of price to book value. That's why we believe that Maharashtra Seamless is a value buy. It is not for faint hearted people. It is a green we believe that Maharashtra Seamless will continue to give good returns to our clients. Now, business concern wise, yes, Ram Kumar from Mumbai, he has mentioned it correctly that uh, there is a cause of dumping by Chinese, but we believe that given the fact that policy initiatives have already been taken across the globe against dumping in China by Chinese on by Chinese piping companies. It has already taken place in certain European countries as well as in US. We believe similar policy action will be taken by Indian government also. This should give support to Indian piping companies who are facing problems because of dumping in piping business by Chinese companies. We believe these are short-term issues. This should get solved over next 6 to 9 months. Yes, in during that period, things can be very weak for the company. I hope this satisfied. But I would also like to tell you that we will be coming out with a much more detailed report on Maharashtra Seamless within next by the 4th or 5th of Feb. That should give you a much more better insight on Maharashtra Seamless. If you have any other concern, please let me know. If we have time, I would address Maharashtra Seamless again later after the presentation. Now about two other companies that I would come into is Sterlite and Hindalco. Sterlite and Hindalco, we like one Sterlite because of it becoming a diversified player. Someone asked about Sesago when I'm answering Sterlite because of the merger that is happening with Sterlite. I am taking both Sterlite and Sesago together. Uh, the bad part is weakness in copper and aluminum prices and lack of bauxite mine. We believe that this thing is an issue that should get solved over longer term. But yes, this one over next 1 or 2 years, these three things would continue to weaken and Sesa and Sterlite. On the positive side, getting Hindustan Zinc Limited and Balco integrated and merged into Sesa Sterlite will be one of the key drivers of valuation for Sesa Sterlite. This is one of the key things that the management of Sesa Sterlite should get it done in 2013-14. On Hindalco, Novelis was acquired because Novelis is not a miner. He does not make some basic aluminum and alumina, but rather uses them to develop higher value added products. Now, Novelis is playing its counter cyclical role that it was expected to play. Weak aluminum prices supports Novelis cash flow, while weak aluminum prices hurts the local business of Hindalco. So while Novelis is doing well, Hindalco local business is not doing well. Hindalco gives a very good opportunity to enter into a business which has a counter cyclical and a business built into it because of Novelis. Given the free cash flow numbers that are been generated by Novelis, we continue to remain bullish on Novelis. Now let's move on to the next sector, pharma sector. This would be addressed by Shaurya.
Yeah. So after addressing all of the queries in metals and commodities sector, we now move to pharma sector. So basically, if we look at the last year, the BSE healthcare index has outperformed the Sensex by close to 10%. This has been mainly on account of the pharma industry doing well because a large number of patents, which is the market size of those drugs has been estimated close to 31 billion, they went off patent. These help most of the Indian generic drug makers to report good growth in US. Also, many companies have benefited from first to file opportunities, which is called FTF opportunities. Uh, if we look at financial performance criteria, most companies which were concentrated in US and domestic markets did well. Uh, on the domestic front, however, growth steadily declined from last 4 quarters after a strong showing in March 2012. Uh, there has also been a slew of regulations for various companies. The government cleared the pharma pricing policy, which placed restriction on multinational taking over domestic firms. The government also cracked down on patent of multinational companies by issuing compulsory licenses to Indian firms. This was basically to enable lower cost drugs to Indian populace. However, it was not a good uh, thing for MNC pharma companies. Uh, Let me move to the next slide. Yeah. So how does 2013 pan out for companies? In 2013, there are many blockbuster drugs which are going off patent. The primary one amongst them is Propecia, and first to file status lies with Dr. Reddy's lab. I guess it should be out sometime close to next 1 to 2 months. Another brands which are going off patent are Valsite, Comtan, Oxycontin, and Venos, and various other pharma companies have filed first to file status for those companies. But overall, the number of drugs which are going off patent in 2013 in US specifically are lower than 2012. Around 18 billion of drugs were expected to go patent as compared to 31 billion in 2012, which is a steep reduction. Uh, and many of the drugs which went off patent in 2012 were blockbuster drugs. Indian companies expected to report good set of numbers in 2012. However, we should also, on domestic front, look at new pharma policies, which brings close to more than 300 medicines under price control. These medicines, which have been brought under price control, account for nearly 60% of the domestic pharma market, with sales totaling close to 29,000 crores. This price will be capped by taking simple average prices of all brands which have more than 1% market share. Uh, so apart from the drug policy and number of drugs going off patent, we also have to look at first to file status. First to file basically means whenever a drug which is going off patent, the company which first challenges gets a 6 months or 180 days exclusivity to sell that drug. Generally, many Indian companies, especially Dr. Reddy's lab, has been successful in past with such strategies. We'll also need to look at some of the mergers and acquisitions deal, which might be a good thing because pharma sector, as you know, is highly competitive intensive sector. So there might be few mergers and acquisitions going ahead. Sun Pharma in 2012 made two acquisitions. Cipla acquired 51% in a South African marketing company. Dr. Reddy's lab acquired Octoplus. Uh, However, other pharma companies, MNC pharma companies like Sandoz or Teva, also acquired companies. And going ahead in future, we can look at some of these MNC pharma companies to acquire some of the smaller Indian companies to expand into the generics market, because their pool was currently limited to drugs which were under patent and which were off limits for generic drug manufacturers. Now, yeah. Now going ahead, what do we look forward in 2013? What do we like or what we hate in 2013? With implementation of Generic Drug User Fee Act, Indian generics company could focus on quality filings over quantity. This could impact US sales in the short run going ahead. M&A deals can also continue going ahead into the future. But the key thing to watch out in the domestic market is that how does the recovery take place in the domestic market? As I told to you in the beginning of the presentation, there has been fall in sales in the domestic market for last 3 quarters. We are expecting the situation should revive sometime. If market continues to be bullish, excuse me, in 2013, pharma stocks can underperform because they tend to be defensive in nature, and any such downside, if it takes place, could provide investors opportunities. Now, if I go into the stock specifics, we are quite positive on Sun Pharma and Dr. Reddy's lab. Sun Pharma continues to be displaying strong growth due to niche portfolio, especially in the chronic diseases in domestic market. It also has a robust US pipeline and increasing presence in emerging markets like, let's say, Africa and even in Latin America. Dr. Reddy's lab, on the other hand, has the best generics pipeline in US and is expected to lead a series of launches in US in the coming year. It has strong momentum in domestic market and it has been improving its market share in Russia. However, one stock which we would be wary of or would be cautious of is Cipla, because domestic business has generally underperformed because of lack of new product launches. Further, the dependence on third party distribution is there for Cipla. It does not have a strong distribution network of its own, and it is generally present in segments where margins are not likely to be high, and it has high capital intensive model which will again weigh down on the stock. So this is about the pharma sector.
Surely, I have two questions for you. Someone was asking whether he has some investment in Aurobindo Pharma. Should he move from Aurobindo Pharma to Sun and Dr. Reddy's?
Aurobindo Pharma is a good pharma company to own and to be a part of your portfolio. However, if you look at the current scenario, according to our valuations, the stock is in overvalued territory. So, considering this, we would advise you to shift from Aurobindo Pharma to companies where prospects are better, like let's say Sun Pharma, which will provide you better opportunities going ahead. And it is also at a 10% discount to its MRP. So we'll advise you that. Which was the other stock, Chaitanya?
Uh, One more thing I would like to ask you is in one of the slides we are shown that the brand value was going off patent was consistently falling over 2020. So does this mean that companies like Sun Pharma who have their own strong growth and a niche chronic portfolio will do better than and those who are focused purely on generics?
Um, uh, Two ways to look at this. First is that companies like Sun will do better because they are focusing more on innovation rather than looking at only the generics market. However, there are a few companies in generic space like Dr. Reddy's Lab who have a very strong portfolio of drugs which are going off patent. And Dr. Reddy's Lab has been very efficient in penetrating those markets. So it has to be seen more on a case of individual companies. I would not say that all generics companies are not likely to do well. However, some generic companies are likely to do well, and many of them would be just market performers. However, innovation companies which focus on innovation, like Sun Pharma, this is a definite statement that they are likely to do well going ahead into the future. Yeah, someone asked a question about FDC. Uh, uh, FDC is quite close to its intrinsic value. So I might suggest to you that please hold on to the stock, but do not add into it. Wait for better opportunities to buy into the stock. However, if you are still holding the company, it might be a good chance to continue holding and then book part of your profits as the stock rises above, let's say, 95 to 100 rupees zone. That is a zone in which you can look at booking a part of your profits if you have invested when the stock price was, let's say, close to 60 or 70 rupees. With this, we'll move on to the next sector, which is auto. So Chaitanya will be taking you through the how the 2012 panned out for auto sector, and then I'll be taking you through specific companies.
Now speaking about auto industry, 2012 was not a very good year for auto industry, with a lone exception of Tata Motors. But if you look at even Tata Motors, the performance was purely coming from its Jaguar and Land Rover division, rather than from its local business. So what the theme that we are running for auto industry is, can we look at in a 2013 as a revival mode? So let's see what how the performance of auto has been. So if you see that largely because of an Tata Motors and to some extent because of an M&M, we are seeing that the BSE Auto Index had performed well compared to Sensex as such, but the weakness in the sector at the business level continues. We see in if I take you to the next slide, just to take you for what I mean. Looking at this particular slide, if you see that we see that over last few years there has been consistent piling up of inventory that is happening. This is certainly not a very good scenario. A large piling up of up to 70,000 vehicles of two wheelers itself has happened over last year, that is 2011-12, in two-wheeler sector. Also you need to while the graph looks shows underestimates it, but 9,300 commercial vehicles translates to about 15,000 to 16,000 crores of inventory lying up within the books of the auto companies. These are not certainly not very good indicators as far as auto industry is concerned. That's why if I come back to my first is the major performers were largely companies in which there were some structural changes happening, or there were companies, these are companies which have derived large amount of their revenues coming from outside of India. So Amar Raja, which was taken over by Johnson Controls, was a good performer. Tata Motors largely because of it. Jaguar Land Rover was a good performer. Maruti, the 2010-11 was not a good year because it was the stock was bogged down largely by the strike. But 2012 that turned out to be a very good year. But industry averages, these are companies that depended a lot on domestic performance. These were Bosch, M&M, Wapco, Excite. These continued to give very low returns. Underperformers, very dependent on auto sector and very not quite good balance sheet and profit margins, where TVS, Ametek Auto, Ashok Leyland, and companies like Escorts. Now, the reason we continue to mention Hero Motors as underperformer is because of the concerns regarding Hero Motors. Uh, excuse me. Concerns regarding the fact that the collaboration between Hero Motor and Honda, which is expected to lapse by 2014. Now, this puts a question mark on the product pipeline of Hero Motors. So this was the reason why Hero Motor was a laggard for the last year, and one of the reasons why we continue to believe that that would continue over the next few years also. Now, what is driving, what is something that I would look forward in 2013? There is very low demand in domestic, and because of the problems in Europe and US, so now we are seeing weakness coming in the export level also. This has resulted in piling up of inventories across all sectors, dominant majorly two wheelers and commercial vehicles. Companies need to focus a lot on production, and they need, if needed, they need to cut down on the prices that they charge at the retail level, so that the inventory can be flushed out, and a large amount of capital can be released, because capital that is not used productively will continue to strain balance sheet and will result in lower valuation for the company. uh, in one thing to note is inventory piling up is not a major issue in two-wheeler business, but it becomes a huge because in two-wheeler business you need to understand 70,000 vehicles in inventory means just about 400 crores of inventory across the whole sector. But it is very important for commercial vehicles and passenger vehicles as the ticket size for these vehicles is very large. It translates to about 15,000 to 16,000 crores on the inventories of companies. Now, what is to be liked about in 2013 will be taken by Shaurya.
Yeah. As we have seen at the beginning of the year, RBI already cut interest rates, and pursuant to that, a few of the public sector banks took lead and reduced their auto loan rates, which is likely to be good for the sector going ahead. We also expect, as I said to you in the beginning of the presentation, that we expect a recovery sometime in the second half of the year, which will also be good for auto companies. However, the current consumer confidence is low, and which might present some more near-term problem for auto companies. However, you will see that as we move towards the end of the year, the outlook would continue to become better. There's also a big possibility, and the government has already told, and it depends whether they want to take through this decision of theirs, that there will be diesel deregulation going ahead, which will hit companies which have huge capacities in diesel vehicles. Yeah, companies like M&M, possibly Tata Motors, and Maruti to certain extent because it has built up big capacities for their Swift range in diesel. So some companies might be impacted because diesel vehicles were earlier selling at a premium when the cost to manufacture both types of vehicle is nearly the same. However, companies could charge a premium because diesel prices were less, and consumers who were into high usage of vehicles generally preferred diesel vehicles. So on that backdrop, I'll discuss with you some companies. Maruti Suzuki is a company which we like in 2013. It has a strong product pipeline, and it is to tap growing markets in Africa and Latin America. Even its India business is going to do well. This is what we expect in 2013. Tata Motors, the critical factor is the performance of Jaguar Land Rover, because domestic business is not performing as expected by the companies. Nano, which was supposed to be the blockbuster from Tata Motors, has still received very average response from Indian consumers. So basically, the trump card for Tata Motors is Jaguar Land Rover, which has been driving up performance for the company. And if Jaguar Land Rover is able to sustain its sales figure, which most of which is coming from product innovation for emerging markets, then it is likely to do well. Escorts is one company which will be wary of because there has been continuous economic value destruction for years. The company is besotted by lower margins, and it is one company where, despite valuations being less, will be very off because it is more of a value trap rather than a value pick going ahead into the future. Someone asks about Aisha. Aisha is a niche player. Basically, most of the future of Aisha hinges on how Royal Enfield performs. And as all of you know, after the product innovation taken by the current MD of the company, Royal Enfield has built up a loyal clientele and even is innovating in terms of product offerings. So Royal Enfield or Aisha holds the trump for Aisha, just as Jaguar Land Rover is the trump for Tata Motors. Aisha will advise you to wait for better buying price perhaps on Aisha. However, this is one stock which you would like to own going ahead into the future. With that, we'll move forward to the next sector, Chaitanya.
Yeah, just moving before to the next sector, what do you think about Ashok Leyland as such?
Yeah, see, Ashok Leyland is a company which has not delivered on its promises for many years. We periodically listen about the tie-up that it is going to have with Volvo, many product offerings. I'll be most wary of the promoters because Ashok Leyland, as all of you know, as all of you might be knowing, is a Hinduja group company, and Hindujas do not exactly have a very glowing reputation in the market when it comes to shareholder returns. Most of the Hinduja group companies have delivered immense value to Hindujas, but not to the shareholders. So, looking at the management ethics and possibly the management quality as a nominal shareholder, probably I would stay away from Ashok Leyland no matter how compelling their future looks. That is what I'd like to say to you. Now we'll move to next sector, which is power, which will be taken by Chaitanya.
Just one word. The reason we didn't cover much on auto ancillary is because the concern over last 1 year that we had seen was towards the demand side in the local itself. Second, what was concern was that even in the global level, we are seeing lower consumption of automobile goods. So because of that, we were a bit concerned on the auto ancillary as such. But yes, there are certain good stories that people can look into. Bosch is a very good story, but it is already well played. The valuations are very extreme high, partly based on the fact that it is a very good delisting candidate also. Similar other companies like Wapco, Lumax, these are compelling valuations, Motherson Sumi, but we would like a domestic automobile sector or at least global automobile sector to stabilize first before we start saying that there are good opportunities within auto ancillary as such. Uh, but yes, if you have any specific concern to any auto ancillary company, we would take it over in the next webinar or so. Moving to the next sector is the power sector. Power sector, our theme is marred by fuel shortages. This has been the driving thing for power sector, is irrespective of the type of fuel they are using. Natural gas based power companies are facing shortage because of the fall in KG D6 and fall in KG D6 basin output. Based companies, while in the initial years, in the initial start of the year, were facing problems because of the high coal prices compared to what they had calculated while in a bidding for the project. High coal prices and fixed enough per unit price of electricity production would result in some of these projects becoming unviable for Indian companies. As you may have already heard, Reliance would that is Reliance Anil Ambani Group would like one of its to take its hands off one of the UMPP orders that it had won from the government of India because of the problems that is emanating from higher coal prices. But as I cleared you at the start during the metals and energy presentation, we do not believe that coal prices will continue to stay high for long term. The reason being, and we are seeing a shale gas revolution happening across India, across US. We believe some things of similar may play out to certain extent in China and to some extent in India once Indian government also comes up with a policy decision on something like NELP for shale gas extraction also. Uh, Given this fact, we believe that coal-based power plants should do well over long term, but some problems may happen over short term to in a medium term range. But coal-based power companies, some like Torrent Power, who is also having a good natural gas-based assets, should do well over long term. Uh, as far as the index is concerned, Sensex clearly outperformed and power. The reason being there are large regulatory as well as structural issues concerned with power sector itself. Uh, Enron story probably seems to be repeating again, wherein the policy decisions taken by government lack in policy decisions taken by government. Uh, their reluctance in taking harsh decisions is leading to weakness in the overall sector as such. SEBs continue to be continue to take up losses. Good part was that state electricity boards across India had taken a power price increase over last 4 5 months. Things should look for SEBs, but if they revert back to their old ways, and overall sector may be under danger. Now, moving forward to 2013, a lot of it depends on availability of fuel for the performance of power companies in 2013. Uh, because of this low availability of power for fuel, we are seeing that the power load factor to think about power load factor, think of it similar to like capacity utilization for that you would think for manufacturing units. uh, it has consistently fallen from 79 percentage to a low of 73 percentage. This is a very low number. Single standing units with an not economies of scale might not even turn an economic profit if they see such low numbers of 73 percentage of power load factor. It is very important that this power load factor be somewhere in the region of 85 percentage to 90 percentage plus. Now, as far as the generation capacity is concerned, thermal power continues to be a major contributor to India's power generation capacity. Uh, because of that, shortage in coal mining by Coal India is one of the significant and laggard to call India-based power companies who had uh, based their project based on another supply of coal by Coal India Limited. This is one of the big reasons. One being Coal India continues to have very low exploration as a percentage of its revenues, very low exploration spend as a percentage of its revenues. This is one reason that we didn't mention Coal India as one of the companies in metals and mining companies. Uh, we hope that this can get rectified, and certainly new coal coming in from US over this year should help and stabilize the situation for power companies as such. Long term benefits continue within the power sector. There is need for distribution reform so that SEBs are able to charge sustainable tariffs in future. Once this happens, the benefits will percolate across the sector. About what is good and bad in power, Shaurya will take it forward.
Yeah. So if you have to cover companies, because Chaitanya has taken you most of the how 2012 panned out and how do we expect 2013 to pan out. And if we look at some companies, possibly I'll come first to Torrent Power, which is possibly one of the best picks in the sector because the company has a history of consistent value creation, a good promoter backing, and it is available at decent valuations. However, on the downside, the company is facing major gas shortages because gas is the fuel used for most of its power plants. So that is one thing I'd look out for in Torrent Power. Tata Power again is one of India's largest power companies. In fact, it is the largest private power player in India. But again, fuel remains a prime concern to Tata Power. NTPC is again the biggest power company in India. However, value creation over the years hasn't been good for NTPC, but at a compelling valuation for an investor who has a long term horizon, NTPC might be a good play. On power related companies, I could see that somebody had a query on Jyoti Structures. So, those companies are good picks. However, I would wait for power generation capacities or power orders to pick up because most of them are ancillary companies, just like auto ancillary companies. If auto sector as a whole doesn't perform, the ancillary companies are not likely to do well. So for any of those power and transmission companies like let's say Jyoti Structures, Kalpataru Power, etc., I would wait for improved order inflow visibility on the side of power companies before I could take a bet on the sector. However, for long-term investors, I guess that this is a good time to enter selectively in some of those stocks like Jyoti Structures, for example. Now, I'll take some queries on a few sectors which we haven't covered. Uh, I received a few queries on real estate and telecom sectors. So two sectors which we didn't cover. Somebody specifically asked about uh, Bharti Airtel that after continuous underperformance and bad results in last 2 or 3 quarters, what are our views on Bharti Airtel? See, Bharti Airtel has been hit by double whammy of uh, decreasing ARPUs in India and the investments in Africa not paying as well as the company management expected. So for coming few quarters, Bharti Airtel is likely to continue underperforming until and unless the management can turn around things. However, looking at the sector as a whole, the time for supernormal returns is over, and possibly most of the companies in the sector are likely to perform more like utility companies going ahead into the future, because the big part of growth is over, and with Reliance entering into 4G data, and who knows, possibly even voice through some backdoor channels, the sector intensive competitive intensity is likely to increase going ahead into the future. So that is what we'll look at. We'll cover real estate, and possibly that would be a good time to take some of the questions on real estate also. Now we'll move to gold as an asset class, and possibly Chaitanya will take you through some of that.
Uh, uh, I think we have one more this. Sid, there are some queries regarding few more companies. These are since these are large companies, I think we should cover them. What do you think is your view on Reliance Industries?
Yeah. So Reliance being the biggest company in India, as most of you who would have gone through this presentation on 13 stocks for 2013 would remember that Reliance is one company which we told you to avoid. This is mainly on because of decreasing capacities. The petrochem refining margins likely to remain subdued going ahead into the future. However, on the other side, the company is into entering into 4G services, which is again highly capital intensive. So the revenue visibility for the company going into 2013 remains subdued on account of all these problems. So I'd like to avoid Reliance Industries at this point of time, because I believe that there will be better opportunities going ahead into future. Any more companies, Chaitanya?
I think Uh, someone made a comment on power sector regarding the fact that sadly in India power sector is powerless. I agree with you, sir. Power sector seems to be powerless, but largely it is a problem created by our government. Unless and until reforms takes place, it would not be possible for power sectors to make decent amount of money in this. Uh, Sadly, because of the nature of the power sector that is in India, power investment in power sector is not for faint-hearted. It is like investment into it is like investment into a deeply distressed assets. Uh, because of this reason, one must be careful while investing into power sector. Someone asked about Suzlon. Suzlon, yes, it has been upward move largely because of two big reasons. One of its subsidiary Repower had got big order in Canada about 350 megawatts or 345 megawatts. Another it also did decently today also again because on the back of another order by in South Africa by other of its subsidiaries. uh, Good news for Suzlon continues for over last over the whole of the January, starting with debt restructuring agreement between itself and its lenders, and continued big orders from Suzlon. The reason I would still ask investors to be careful about Suzlon is one very big reason that they need to be clear. The margins in the windmill business is just about 6%, and this is the margin before interest and taxes. Even assuming that Indian lenders have agreed for foregoing their foregoing their interest for next 2 years, what is not to be forgotten by this is that those interest that they are foregoing, that would be about 1500 crores, will be translated into equity. When the market cap of the company itself is about 2500 crores, this will mean that 1500 crores would lead to a large dilution in shares of an Suzlon. While good on the business side, but investors who are investing as of now might not get uh, risk adjusted well return. Risk adjusted in the sense, while yes shares may go up, but there is continues to exist very huge downside to the business of Suzlon also, given the fact that margins in that business are very very low even at the operating level. So this is one risk that they need to be careful about. Some amount of Suzlon is good, may help your portfolio, but it should not be such that it should dent the overall performance of the portfolio as such. So probably 2 to 3% within your portfolio may be okay, but it comes with a huge amount of risk within your portfolio. Let us move to one industry that we would like to cover, that is cement industry. Cement industry we are covering. It's not that big a sector as such, but we are still covering it because of perception within the investors that it will be one of the biggest and gainers over the last 1 year. If I look into big cement companies, if your timing was not correct, cement companies might not have given you very good returns. The best timing to pick up would have cement company would have been once there was huge risk within the cement sector itself because of the expected and a report on competition by Competition Commission of India. If you would have bought around that time, you would have made about 15 to 20% return in a large cap. The big returns, though, were significantly seen uh, companies like JK Lakshmi, Shri Cement. These were companies from a large to medium scale, though Shri is much larger company. But these are companies who are focused in certain particular regions itself. Once these regions started becoming stable as far as cement prices are concerned, cement companies did well in that particular region. So you had Sri Cement perform and JK Lakshmi performing well in the who was largely present in northern region. You had Heidelberg performing well, who is largely present in the central India region. So it was largely sectoral, it was largely geographical pick based. You have to be very selective while buying into any cement company over last 2012, and this is what I believe will continue over next uh, year also. The thing that was negative for cement company over last year was the expectation of high coal and fuel prices. uh, well, as I mentioned in my first half of the presentation, that the coal price we do not see it to be at too high prices over next few years. So this is a very big positive for cement companies. But on the negative side, I see that the price on the cement will remain very low. Will not recover to its similar growth trajectory that it had in 2007-8, because given the economics of the business, for a cement company to make a decent amount of money, it would need cement to be priced at 300 rupees plus per bag. uh, which is happening in some of the regions but not in many in other part of the region, especially south. That's why south based companies might not continue to do well. uh, what is something that I would like to see over 2013 is specifically I would like to see very low level of fiscal deficit in the very low level of fiscal deficit uh, by our finance minister. Fiscal deficit of 4.8 would be extremely good. If we could manage that, that would really help in leading investments into by a private sector. That should help cement sector. Yes, there is another theory also that goes around, that what if the government comes out with a very populist budget. We believe this kind of populist budget, while it helps for 1 quarter to 2 quarters, but then it fizzles out. But in the process, it creates much more longer term problems for the sectors like cement, which are more which do well if the overall economy is expected to do well over the long term, rather than see in a short in a spurts of growth. Over 2007 to 10, the problem was that the coal prices and crude prices were increasing. We believe that this will not be a continuous problem going forward, and that's why the pressure on the fuel will not continue. ठीक है. Companies that I like, Grasim, one company that we'll continue to like is largely because of its non-cement business, because the its a textile or chemical business continues to be very value creating, which is not yet realized by the market, and that's why investing into Grasim around the time when it is getting weak may be very good for the investors. Speaking about ACC and Ambuja, we believe these both these companies have been consistent value creators over last decade, especially Ambuja. That's why if you see, Ambuja has also given a positive returns for its shareholders each of the year. Over last few years, we are seeing that there has been a large amount of cooperation that is happening in between ACC and Ambuja, largely because these both are wholesome companies. We believe any merger that may happen or any continued cooperation in between ACC and Ambuja should drive valuations for both ACC and Ambuja. About small caps, I would request most of the investors to stay away from small caps in 2013. There can be some selective companies wherein you can look in for investment, but largely small cap cement companies would be a no-go companies for investment in 2013. Selective picks, yes, they will always remain.
Yeah. So now we'll move on to gold, because most of you are quite interested with gold prices rising up. So we thought it will be appropriate for us to look at some of the things. Chaitanya, can we move to the gold slide? Yeah. So uh, as you can see in the slide above, which displays a close to 100-year chart of gold, you can see that gold has gone through many. Yeah, the chart on the top, which is the brown chart that you can see, it is gold price chart, and the chart or the line, blue line that you see at the bottom is inflation adjusted gold price chart. So as you can see that from 1913 to approximately up till 1970, gold prices continued to languish. Then they showed some spike in coming 10 years or so, after which again the price remained constant, and it again spiked up from 2004 onwards, when the economic situation in the world started turning dire. So gold acts as a good store of value, good for inflation adjustment, and it is also a real store of value. It's not a fiat currency, it's a currency or money in real terms, or as economists like to call it, store of value, perhaps. So gold should form a certain part of your portfolio, however not a very large part, especially for a portfolio where the idea is to make gains in the long run. Yes, there might be cycles in economy where gold will tend to outperform, and outperform uh, perhaps to a great extent in economic downturn or economic depressions. But as soon as economic situations continue to normal, you might experience a long period of stable prices, which might be not good for your portfolio. So please continue holding gold in some part, but not a very large part of your portfolio. Chetan, do you need to add something to that?
Uh, Folks, I would like you to come back to this graph once. The reason we have put this graph is for you to bring to the perspective that if you look at gold as a inflation adjusted price, the current price of gold is already current price of gold is already moving towards its peak levels. Uh, because of that, I would like you to reiterate what Shaurya had already said. Please have some amount of gold in your portfolio, but if your portfolio is largely based on gold, then probably this may be right time to diversify away from gold to certain extent. Now, Shaurya, let's move to real estate. It seems there is a huge expectations from real estate. Most people will be interested in real estate either for buying homes or even looking at real estate as a investment, real estate companies for as from an investment point of view.
Yeah. So the metric to look in real estate is price to rent yield, because that is a very significant indicator of whether market is pricing itself correctly, or there is a bubble or froth in the market. As you can see that the average time rental takes to pay for the price of a building in India is very high. It's close to 37 years, which means that if you buy a home or a flat in India and you expect the price recovery solely based on the rental income, it will take you as long as 37 years. In Indonesia or Philippines, these numbers are as close as 11 to 12 years. So, if we can move to the next slide, perhaps, it again reiterates the same theme. In New Delhi, the rental yield is close to between 1.6 to 2.5%. In South Mumbai, it's again hovering around 2.5%. However, Bangalore is one of the better markets where rental yield is between 3.5 to 4%. So again, in real estate, I'd be wary of those cities where the price rally has been very high in recent few years. However, still in India, there are a few pockets where you can think of investing in real estate. So the markets in India where you can still consider investing in real estates, among the big markets, those markets are Bangalore and Ahmedabad. So those are the two markets where you can still consider investing in real estate based on the price, which is not at a very exalted level. However, in markets such as New Delhi, especially the Greater Noida Corridor market or Sector 37 Gurgaon market, in South Mumbai, especially in the suburbs, in markets like Pune, you might do well to remain cautious. There's a specific stock query on HDIL. In HDIL, the biggest problem, Arun, is that the owners of the company are left with very less cash on their hands. They have gone in for aggressive expansion. However, they are finding it very difficult to meet their debt obligations. So, as you can even see in our 10-year exit, the company is rated red, and it is not a good company to invest in for investors. There might You might feel that the valuations are very compelling, but if you look at the amount of risk that you are taking to buy such a company, I'd advise you to stay away from stocks like HDIL, or even let's say stocks like DB Realty, which might look to you to be coming at a very compelling price. But when you look at the risk associated with these stocks, it doesn't justify you investing into those stocks. There might be a possibility where, when the situation improves, the stock price rises. However, the thing is, the amount of risk you are taking to buy such a stocks doesn't add to why this stock should be a part of your portfolio. Possibly Chaitanya can add something more, and then we can wind up this webinar.
Uh, Folks, as Shaurya already said, there is huge amount of corporate governance problems that is creating issues with most of these real estate companies. This is the because of the nature of this sector itself. Unless reforms at the legal level are taken place, and companies themselves take effort to uh, make their corporate governance bit better, you would continue to see that these type of companies may ride the bull at in a very frothy times, but most of the times they will see in a very low levels of valuations compared to what you may see at other sectors. Ideally, I would really suggest most folks to stay away from these sectors. Probably some good real estate companies that which have good corporate governance that they can think of.
Yeah, there are a few good companies in real estate sector which you can do possibly well to invest in at right prices. Those companies would be companies like Phoenix Mills, companies like Oberoi Realty, uh, even possibly you can think of Godrej Properties at the right valuation, or Purvankara, Ashiana Housing. Even if you see in the last year gone by, Phoenix Mills or Ashiana Housing went from our DP to MRP. But you should wait for the rise price point to enter into these stocks. I guess we can request you to take up a questionnaire, which you can do finish before you log off, because it will be very vital for you and will help us to serve you better in going ahead. I thank you all of you. I understand that you had many questions, but which might be separately addressed in the query webinar or through mails via customer care. I thank you all for your patience and being patient to listen to this long webinar. And I hope that in 2013 you will have good investments and it will be an enriching year for you. Thank you very much.